Okay, let's take a look at LinkedIn. I think many people on the call should be familiar with the site. IPO date was May 19th of this year. It IPO'd at 45, now trading at around 70. Now, the IPO price is a little bit misleading because as soon as it hits the market and starts trading for a few days, the price was at around 95. So it's fallen since then to about 70. So pretty hefty loss for just less than a year. And its profit the first 9 months of 2011 was only $5 million. Let's not forget. And the valuation that they currently have is completely astronomical. That's another thing. When you look at multiples, how a company is valued relating to its revenue, relating to its sales, and relating to its book value, a lot of these companies are in the triple digits. So you'll have a company that's valued 100 times over its earnings, 100 times over its sales, the PE ratios. None of the ratios make sense on these IPO stocks. And this is, of course, very similar to what happened in 2001, 2002. Most of those companies had outrageous valuations, outrageous multiples, and finance always tends to bring people down to reality. And if the ratios are unsustainable, which means that they don't really represent the growth prospects of a company, then the downside can be devastating because investors tend to piece this together as time goes along, and pretty soon the stock price does reflect the actual value of the company. Usually it's the retail investors taking that ride all the way down. It says investors initially didn't seem concerned that until last year, the company, LinkedIn, was in the red almost every year since its 2003 inception. In 2006, it did turn a slight profit on sales of $32 million. But shares began dropping in May, and by June 20th, LinkedIn was below $64 a share. Let's not forget they were trading about 90-something earlier in the year. A July spike took shares back to nearly $110, but they took another dive in late November when LinkedIn insiders began unloading shares. And that's it right there. That's what I referred to before. When you get into an IPO as a retail investor, the people that got in before you and the institutions that got in before you are just waiting for that spike. You're just waiting for the stock to go up as high as possible, and they're going to hit you hard by selling everything they have. And this is exactly what happened here. When the LinkedIn insiders, this happened in November, when the insiders began unloading shares. And let's take a look at this chart. We can see that the shares are right around 95. And in November, you could just see the straight decline down to almost 60. That's selling. That's insider selling right there. That's absolutely one of the best examples I could show you. It says IPOs typically come with lockup agreements, preventing employees and early investors from unloading their stakes. LinkedIn's expired on November 20th. A few days earlier, LinkedIn revealed that its early investor, Bain Capital, planned to dump its entire $275 million stake. Okay. Now, it speaks for itself. When you have a group of early investors, that's all they're waiting for. They don't need the company to do well. They don't need to be responsible for it. They want to make their cash as quickly as possible, move on to the next idea. Just goes to show again that IPOs tend to, as I said before, eventually reveal the true value of the company, which may be quite disappointing and quite different from its IPO price. It says an analyst called the decline an implicit acknowledgement that perhaps LinkedIn really is overvalued. Well, are you telling me triple-digit valuations are unrealistic and triple-digit multiples? It says the analysis set a LinkedIn price target of $43 a share, sharply below the current price. So they're saying that there might be some more downside here. I can't really disagree with them, to be honest. Until the multiples get to a realistic range that's comparable to other companies in the industry, then I would also I wouldn't argue with the fact that the company might still be overvalued. So here's another sort of close-up of the chart. It's quite painful. It shows you how volatile IPOs are as well. They really tend to move around a lot, which to an active, astute investor who's a day trader, this may work in their favor, but to the average Joe, this is definitely not the place to be. Another company, Pandora, is a music company that provides streaming music over the internet. They IPO'd in June 15th of this year. And it says, Pandora's IPO paperwork warned investors that expected to continue losing money through at least fiscal 2012. But demand still seemed high. So after Pandora set a target range price of $7 to $9 per share in June, it quickly upped the range to $10 to $12 and eventually priced at $16. Now, why would a company increase its projections? Because of the hype. The better these people market these securities to people, the more they're going to be anticipating them. And this is just another example. So when the stock began trading on June 15th, it initially shot up 63% to $26. But trading cooled as the day went on, and shares closed near the day's low of $17 and some change, which just, again, goes to show you the volatility that's possible. Overall, Pandora's stock lost more than 32% in November. So there it is. It's Pandora. Here's a close-up of that stock chart for you. And again, it shows that these stocks tend to move around, and unless you're hedged or you're protected in some way, then it's really a dangerous situation. Another company called Zillow, which is a real estate site, Zillow.com, says has a river of red ink. I already like it. When Zillow filed for its IPO in April, it revealed that its revenue jumped 74% in 2010 to $31 million, but it lost nearly $7 million that year. Okay, so another company that loses money. It's not unheard of, but not the stock that I really want to be investing in, especially this early on in the game. It says Zillow stock quickly shot up 120% in its July debut and ended the day 79% higher. But Zillow's IPO comes at a rocky period for the housing sector, which has yet to stage a sustained recovery. So it's still above its IPO price of $20, but as we can see in the chart, it begins trading at around 35. Now it's trading at about 23. So big loss there as well. And that's just how it works with these IPOs. Another example is Groupon. Now Groupon is a especially interesting case because they were playing accounting games to a great extent, and I love accounting games. It just really goes to show how people are willing to buy into IPOs no matter what. I mean, it's quite astonishing. It says Groupon, hailed by Forbes as the fastest growing company ever, which is part of the hype that's typical with IPOs, was controversial even before the Daily Deal site filed its paperwork to go public. Business owners have loudly complained that doing business with Groupon isn't worth it, and the barriers to entry in the Groupon coupon business are so low that Groupon needs to maintain an expensive marketing campaign to lure customers to its service instead of one of a dozen competitors, which again touches upon the limitations of .com companies and shows that you have to really be on top of your customers to avoid losing them. Once Groupon did disclose its financials in its IPO filing, the situation got even worse. Tell me more. The company was barraged with criticism for unorthodox accounting measures, which led to several downward revisions of its financials. These restatements effectively cut Groupon's reported sales in half to $688 million for the first half of 2011, down from the $1.5 billion it claimed previously. Now, to summarize, what Groupon was doing was saying, okay, we're a coupon company, so people will come to our site. Let's say something costs $100. They'll come to our site, and they'll buy that service from us. Instead of going directly to, let's say, the spa to buy the $100 spa treatment, the customer will go to Groupon and buy that treatment, let's say, for $50, and Groupon will take a commission on that $50, so let's say 10%. So the entire cost that the customer is paying at that point is $50, and Groupon, let's say, keeps 10%, which is $5. Now, keep in mind that although Groupon takes in $50, they absolutely do, they're basically holding the difference between their commission and the total price, which is $45. They're holding that temporarily because they're going to pay it off eventually to the company providing the service. The thing is, Groupon decided, hey, let's count the whole thing as revenue. Why not? let's count the whole $50 that we get as revenue that we are supposedly earning, which is simply not the case. And accounting standards clearly dictate that you can only recognize revenue if it's indeed revenue, and this is just not the case with this. If you know you're going to pass the money along and you're just acting as an intermediary, a short-term intermediary, no less, you definitely should not be counting that as revenue. So they're the fastest growing company ever, even though Groupon doesn't seem to have a great grasp on their accounting and had to revise their sales and cut them in half. So it just goes to show you another very interesting case where people just jump at the opportunity to trade a complete dog of a stock. Despite all that, Groupon shares soared 30% on the stock's first day of trading, at one point topping $31 a share. Like I said, people love this. But the hype was short-lived. Groupon shares are down more than 27% since their debut last month. They trade now around $1 below the IPO price. So here's the close-up of the chart on that. And again, you can see how devastating the losses can be on these securities. And notice a lot of them tend to move. They tend to be very volatile, but they tend to move downwards. You know, it's not like these securities can go up or down or some are making a complete killing. A lot of these .com IPOs are repeating the same pattern of a few years ago, which shows that if you invest in a company that is losing money, that's playing accounting games, and doesn't seem to have a great grasp on what actual sales revenue is comprised of, you're going to be in trouble.